Welcome to Surya Academics. Please like, share and subscribe to our channel. Thank you. This is the first session for the FRM courses and this is a chapter from financial markets and products. And the first chapter is what are the various types of risks in the banking industry. This is section 1.1, the risks in the banking. The textbook has focused on the three different types of risks. They are market risk, credit risk and the operation risk. Before understanding these three risks, let us understand the activity of the banks. On the left hand side, I have mentioned it as source of funds. On the right hand side, it is application of funds. The meaning of the source of funds is nothing but that is the place from where the banks are raising the funds, and it is a liability for the bank. So these are all the liabilities for the banks. So let us understand what are the types of liabilities. The first one is the current deposits, which means the banks need to pay at any time when the customer demands. The second one is the savings deposits, which means the bank customer may keep the money maybe for a 1 week or 1 month, but not for a longer term. The third one is the fixed long-term deposits. These are also called as the fixed term deposits or long-term deposits, where the banks accept the deposits for a long term with an agreement between the customer and the bank. And sometimes the banks may borrow from the Federal Reserve or the Reserve Bank of the respective countries. The banks raise the funds in the form of the additional Tier 1 bonds, and the bank will have its own core capital or the Tier 1 capital. So basically these are all the source of funds and these are all the liability side of the bank. Now let us understand the asset side. Once the funds are raised from these different sources, the banks invest these funds into different activities. Some of the funds may be kept with the Federal Reserve for a short term, and some of the funds may be invested in the government securities, which we call it as the G-Secs. The funds may be invested in tradable securities, and the funds may be invested for a long term, which I have not mentioned here. And the funds may be used for giving the loans and advances to the customers. So basically, if we understand the balance sheet structure of the banks raise the funds from different sources, and the banks, they invest the funds in different activities. Now, we need to understand how the first risk, that is the market risk, will affect this balance sheet. Now, there are certain factors affecting the balance sheet of a bank, but these factors are outside the purview of the bank. The bank cannot control these factors. And these factors or these variables are affecting the balance sheet of a bank from the outside and from the market. Now, let us understand what are the factors that may affect the balance sheet of the bank. For example, let us say that take the case of these long-term deposits. Now, for example, let us say as of now, currently the deposits on these deposits, the bank is paying around 2% rate of interest. And in the market, if the rate of interest is increasing in the next few months, if it is showing an increasing upward trend of the interest rates are likely to increase because of the shortage of supply in the market. So the same rate of interest, which is now as of now it is 2%, the bank may have to pay 2.5% or 3% on these deposits. So which means it is an interest expense or it is a future expense for the bank. So it will affect the profitability of the bank. Now let us take another example. Suppose take the case of the commodity prices. Suppose if the bank has, for example, if the bank has given the loans for the commodity traders, or it has already invested in gold or platinum or such commodities, any fluctuation in the price of commodities will have an effect on the profitability of the bank. At the same time, it will have effect on the liquidity of the bank. Let us understand what is liquidity later on. First understand these are the three factors, they will affect the profitability of the banks. Similarly, the exchange rate fluctuations in the market, it will have effect on the asset side or it can have the effect on the liability side also. So basically, there are certain factors which are outside the purview of the bank, which cannot be controlled by the bank, and these factors are coming from the market, and so that is why the market risk factors are affecting the balance sheet of a bank. That's why we are calling it as the market risk. So we understood, actually these are all the different types of activities the bank is taking. These are all the different activities, and any of these activities can be affected adversely because of these three factors. Now, here it is mentioned only three factors, but there can be some other factors also. For example, let us say that actually the bank has invested in the stock market or some of the shares. So any price in the stock markets, any fluctuation in the stock markets can have effect on the asset side of the bank. Now, if we take the case of the balance sheet of a bank, this balance sheet can be divided into two categories. I have mentioned it as investment in the tradable securities. And let me write one more thing. This one I am writing it as investment in long-term securities. Now, I am calling it as the tradable securities and I am calling this one as the investment for the long-term securities. We need to understand what is the difference between these two. The tradable securities, basically the thing is the banks will buy the securities today or tomorrow and maybe after 2-3 days they will sell these securities. They are kept for a short-term profits. They are kept for the only for the purpose of tradable, which means actually they are not willing to keep these securities for a long term. These securities are mentioned only for a short-term profitability and therefore sometimes these securities can also create losses to the banks. Though these investments are meant for the short-term profits, the same securities can create even short-term losses also to the bank. So basically when we look at the asset side of the bank, especially the investment in the securities, investments in securities can be classified into two types. One is the tradable form and the second one is long-term securities. Suppose if you take the case of the investment in the long-term securities, basically the banks invest in these securities with a maybe for a 3-4 years or for a long-term view. So these are all long-term assets for the bank which are not meant for short-term profitability creations. So basically, if you look at the observations after 2007-2008 financial crisis, the banks have been very clearly told to identify the securities into two categories. What are the securities that are tradable and what are the securities which are kept for long term? And that is why any securities that are kept for tradable, it is classified as the tradable securities, and any securities that are kept for a long term, they are known as the long term securities. And this one, it is called as the trading book. This book is called as the trading book and this book is called as the banking book. So basically the investment in the securities is classified into two categories. One is the trading book and the banking book. Now what is the trading book and what is the banking book? How these whether these books are outside the balance sheet or not? Let me explain you. Actually everything is part of this balance sheet only. But only thing is, since the banks are having different type of risk in these two books, in these two securities, the Federal Reserve and the respective central banks have come out with clear guidelines they have told the banks to clearly demarcate the securities that are kept for profitability, short-term profitability, and the securities that are kept for the long-term profitability. So anything that is kept for short-term trading, they are called as the trading book, and any securities that are kept for the long-term purpose, they are known as the investment in the banking book. Now, let me go to the other part that is called as the credit risk. The single definition of the credit risk is the default risk. Now, let me make you to understand how this credit risk will come for the banks. Let us now focus only on one topic that is called as the loans to the customers. Let us concentrate on this single topic to understand what is the credit risk. Now, the customers can be classified into different categories. For the sake of understanding, let us classify them into three categories. The low risk customers, medium risk customers, and the high risk customers. What is a low risk customer? Which means this customer has got less probability to default. Which means all these customers, they will surely pay the loans back to the bank. What about these customers? These customers generally they pay with some delay. So basically these customers are also good, but sometimes they have got some delay. Now, what about these high risk customers? These are the customers which may become bad debts, which may become non-performing loans, which may become as a non-performing assets in future. Now, let us understand what is this category. These categories have called high probability of default. Now I am introducing a new word to you that is called as the PD. This is nothing but the probability of default. Now, when the probability of the default risk is very high, we classify those customers under the high risk borrowers. So which means in future the bank may have to lose some amount that is given to the customers. So the bank may have to write off, or the bank may have to go for legal actions. So these are all the customers which are likely to create problems for paying the money back to the bank. So any risk that is coming from the customers by not paying the installments, by not paying the loans back to the bank, this is nothing but the credit risk to the bank. So in short, the credit risk is nothing but the default risk for the banking industry. Now, let me make you understand what is an operational risk. Any risk that is not market risk and any risk that is not credit risk, it can be classified as the operational risk. Now, to make you understand what is operational risk, let me tell you something. Let us say there is a customer who has come to the bank with a forged check. This check is forged, which means actually he is not the real customer. He brought a check which is forged by him. He got the check from somewhere in the market, somewhere on the street, and he brought this check to the bank, and this signature is forged. He got a blank check and he has forged the check, and he has submitted to the bank, and the bank has paid this check. This is nothing but an external fraud. This is a fraud, and this is an external fraud. So basically operational risk comes in the form of the frauds, failure of the systems, failure of the processes in all these activities. So basically operational risk is nothing but the operational risk comes because of the things that is outside, which is not market risk, which is not the credit risk. So operational risk can come in the form of the failure of the systems, failure of the processes, or the fraud, internal frauds, or the external frauds, or maybe because of the some other things like which is maybe the employees have gone on the strike. So these are all the examples of the operational risk factors affecting the banking industry. So we have already discussed what is market risk, what is credit risk, and what is operational risk. So I have given you a brief introduction of the different types of risks to the banking industry. Now let us understand what are the important topics from the FRM examination perspective in the next video session. Thank you so much.